Every pullback has been a great opportunity. Last year, the tariff-related drawdown was on April 7th, turned out to be one of the best entry points in the last 5 years for anyone buying stocks. There were so many stocks that made new all-time highs, but really explosive rallies. So I think this year, if what we think happens, it's going to be a great buying opportunity.
In today's video, we're breaking down one of the most important macro discussions you can hear right now. Tom Lee's perspective on gold, crypto, equities, geopolitics, and the structural shifts shaping markets into 2026 and beyond. Tom Lee begins by explaining why gold has been performing so well, and the first layer is what he calls the visible reasons. The most obvious factor is political and geopolitical uncertainty. We're living in a world defined by wars, rising global tension, and fractured trade relationships. Even when the U.S. economy performs relatively well, uncertainty itself drives demand for defensive assets. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
I think the visible reasons for gold doing well is one, I think that there's a lot more political and geopolitical uncertainty in the investment environment because we have wars taking place. And of course, we have a president in the U.S. that I think has actually done a good job on the economy, but has raised divisiveness and uncertainty about trade globally. A second is that global central banks are generally easing. And in the U.S., we're finally getting an easing cycle, including QT ending. That should support gold. The invisible reasons are, number one, I believe Tether, which is the largest stablecoin provider in the U.S., has become the largest private buyer of gold because Tether is already sufficiently collateralized with Treasury backing every stablecoin unit, but they generate income, and with that excess return, they're buying gold. So I believe that they've been the largest net buyer since July. Gold doesn't make sense if you're trying to view it as a commodity metal because total gold sales last year, industrial and retail jewelry is like 120 billion, and it's a 30 trillion network value. So price to sales doesn't make sense. And we know gold is not scarce because it is there's a million times more gold underground, and all gold is extraterrestrial. So SpaceX might discover a gold meteor, and suddenly gold supply would be huge. Yet gold has worked as a store value for centuries. And it's, as the reasons I explained, it acts, like you said, an alternative to the dollar, which means maybe we should view it as a dollar alternative. And by that measure, everything else is debased against gold. Crypto was outperforming and keeping up with gold until October 10th. And on October, Bitcoin, for instance, was up 36% and Ethereum was up 45%. So Ethereum was outperforming silver. But on October 10th was the single largest deleveraging event in the history of crypto, bigger than what happened in November 2022 around FTX. And after that, Bitcoin lost more than 35% of its value, and Ethereum fell almost 50%. So I think crypto lost its tracking to gold because of deleveraging within crypto. Crypto has periodic deleveraging events. It really impairs the market makers, and the market makers are essentially the central bank of crypto. So many of the market makers, I would say maybe half, got wiped out on October 10th. So until we get to the day where crypto is widely mainstream supported by institutional investors, the internal deleveraging events kind of knock it out of the sky. And if gold and silver and copper do have negative returns this year, then basic materials is not going to work as a trade. But part of our belief is that gold has made a big move, but it's going to be silver and copper that have good years. And as you know, copper is an industrial metal, I think, linked to the ISM. So if copper has upside, I think it leads the basic materials stocks higher. I think it means gold should be sitting in a portfolio. I've seen folks like Ray Dalio recommend up to 10%. but let's say it's 15. Most people are at 0 for gold. So that means gold is still underowned today.
While gold has already made a major move, Lee believes the next upside could come from silver and copper. Copper in particular is an industrial metal tied closely to economic activity and the ISM. If copper moves higher, it suggests improving growth expectations, and that tends to lift basic material stocks. This matters because even if gold, silver, and copper had negative returns in a given year, Lee still believes gold belongs in a portfolio. Ray Dalio has recommended allocations of up to 10%. Lee suggests it could be as high as 15%. Most investors? They're still at 0. That means gold remains structurally underowned.
I think when we look back at the end of this year, I think 2026 will look like a continuation of the bull market that started in 2022, but and really a period when economic resilience is much more visible. But at the same time, there's 2, I think, substantial transitions that the market has to grapple with. Maybe 3. One is, of course, a new Fed. And, the market always tests a new Fed. And that process of identifying and then confirmation plus the market test can create a correction. And I think that in 2026, our view is that the White House is going to be more deliberate in picking winners and losers. In 2025, that caused a lot of disruption for technology, IT consulting, and for healthcare. And this year, there's a lot more industries and sectors and even countries in the bullseye. And I think that creates uncertainty. You can tell by gold's rally. And so I think those 2 factors can cause a drawdown in 2026. So the third is that the market is still trying to understand how much is priced into AI. And so our view is still a strong narrative. But as you know, there's questions about the longevity, how much energy we really need, data center capacity. And so until the market is comfortable that there's other stronger narratives, which I think there's plenty, like the ISM is turning up, I think housing could recover as rates are cut. But that transition, again, would cause uncertainty. So I'm guessing that the 3 collectively could cause a drawdown that feels like a bear market.
So implicit in that is what, like a 20% peak to trough pullback or more or less?
Yeah, it could be 10. I mean, if it's 10, by the way, it's going to feel like a bear market, but it could be 15, it could be 20. But something that maybe brings us to a round trip from the start of the year, because we've started off strong. Maybe we'll be down year to date at some point, but then I think we really finish the year strong. Every pullback has been a great opportunity. Last year, the tariff-related drawdown was on April 7th, turned out to be one of the best entry points in the last 5 years for anyone buying stocks. There were so many stocks that made new all-time highs, but really explosive rallies. So I think this year, if what we think happens, it's going to be a great buying opportunity. In fact, I think 404 still look quite visible. The U.S. does have a favorable demographic tailwind that is in contrast to other countries where the prime age workforce has gone into deficit. In terms of inherited wealth, I think there's a lot more conversations about it, that Gen Z and millennials and Gen Alpha, they are set to all inherit substantial sums of money over their lifetime. And it's strange because it does create disparity in wealth. There are going to be some very wealthy Gen Z, Gen Alpha, and millennials, while others are going to be, of course, living their life and accumulating their own personal wealth. And then with regard to AI, I would say that, evidence that we could be moving towards super intelligence is accelerating. And I think there's a lot more progress being made on robots and integration with robots. So those are all things that are going to favor the U.S. And then on blockchain, it's not just BlackRock and Robinhood anymore. Jamie Dimon has publicly stated that he thinks blockchain does fix a lot of problems for financial services. So I think the banking industry is starting to embrace the efficiency of blockchain. Our institutional clients aren't that bullishly positioned at the moment. And until we get to the point where both the public and institutions have positioned in a way that good news doesn't make the market go up, I think stocks still have upside. That's why the fact that stocks were good in the first week of January is a good omen. and it looks like we're going to finish the month positive. That suggests strength in the early part of the year. Margin debt is something we can watch, and we've been tracking it. NYSE margin debt is at an all-time high, but it's only risen 39% year over year. Usually for a local top for markets, you want to see that rise 60% year over year. So there's a chance for essentially leverage to accelerate, and then that marks a local top. Last year, investors did a fire-ready aim. Whenever they saw the tariff conversations escalate and become uncertain, the market really reacted poorly and fell sharply. I think that this year markets are going to be a little more measured. So let's say it's half the amplitude of reaction. But then there is still the uncertainty of how the Supreme Court will rule around the tariffs. And maybe if that rules against Trump, then it's going to look like the leverage of the U.S. has dropped, and so the White House might take more extreme measures. That could cause greater uncertainty. But over the weekend, I've been reading the news. I mean, there's some folks suggesting the Supreme Court might actually rule in Trump's favor. So I really don't know. I think it's still the same situation in the sense that there are implicit threats being made against the Fed, including this DOJ inquiry. But I think there are still voices in the White House that are kind of saying, let's not undermine the Fed completely, because markets know, and market history knows, that the Fed is still the most important entity in the world. And to undermine the credibility and the independence would unleash a lot of uncertainty. We also know Fed Chair Powell's term is up this year. So there's a bit of let the clock run, because we know that there'll be a new Fed chair. And I think once we have that in place, I think the White House can be satisfied. And as you know, who the next Fed chair can be, I mean, the odds keep shifting. Now it looks like Hassett has dropped as the probable, and Warsh and even Rick Reeder are ascending. So I think it is good for equities in the sense that inflation has been the market's fixation since 2022. Part of it, of course, is because the Fed has been fighting an inflation war, and the Fed wants to maintain credibility by being tight. But when I look at the economic data, and I'm not an economist, I think the underlying inflation is actually much lower than the printed. I mean, a simple thing to point to is something like Trueflation, which is showing 1.8. If you look at median inflation, it's at 1.8. And the thing that's keeping inflation high is housing costs. But housing prices are falling. So the way that housing is measured in CPI is with a lag. So to me, I think there is cover for the Fed to cut. And if housing, as you know, affordability is a problem, we need to do something about mortgage rates, and that is helped by cutting. And even things like consumer installment debt, those can come down with rate cuts. So I think burdens on a lot of Americans can actually ease with Fed cuts.
Tom Lee's message isn't that markets will go straight up. His message is that volatility is the price of opportunity. Gold is rising because trust is fragmenting. Crypto is volatile because it's still maturing. Equities are resilient because liquidity is returning. And the next correction, whenever it arrives, may feel terrifying in the moment. But history suggests it could be one of the most powerful opportunities of this cycle.